Welcome to My Money Mindset podcast, where we explore how a healthy mindset is the foundation for financial success. Each week, we delve into mindset hacks and practical strategies to help you enhance your income, help you make more appropriate investments for yourself, and to improve your overall financial well-being. Join us on this journey to transform your financial future by transforming your mindset. Please note that the information provided on this podcast is for general information purposes only and does not constitute as personal, financial or health advice. It has been prepared without considering your individual objectives, financial situation or life needs. Before making any financial or health decisions, you should consult with a qualified professional or financial advisor to ensure the information aligns with your specific circumstances. So let's begin and enjoy this journey as each episode teaches us on how to improve our overall mindset that it overall improves our financial success. Hello everyone and welcome to 2026. It's another episode of Money Mindset, and I suppose the first thing I really want to put on the first episode of 26 would be probably what's the most pressing finance topic in Australia's property sector at the moment. What's going on and what are the issues, or what are the foreseeable issues and the rewards sort of thing moving forward for your investors or potential wannabe property owners. So I suppose supply demand paradox is where I actually labelled it late last year, early this year, where a situation where the property prices continue to rise or remain stubbornly high despite the low affordability and the sudden unexpected threat of further interest rate hikes by the Reserve Banks. So they sort of put the hard word on it late last year, where everyone was sort of anticipating that their rates would probably stay steady or if not go down. There is a possibility that there could be a rate hike simply because of the inflation figures that were stated, which was late last year. Now, how does this sort of, and when I say they're stubbornly high, simply because the demand and supply, so the supply is down and the demand is still up. There's a few reasons for this, and I labelled it out, and I'll go through all the problems that we foreseeable or the issues that we see in the year to come of 2026 with property and finance, and then at the latter stage of the episode I'll go into the potential solutions or what we should consider as a solution. But the first bit was the interest rate or pivot fear. So the market began 26 with a sort of jarring shift in sentiment simply because of this, and like I said, we were expecting the rates to sort of stay or if not go down. So while 2025 saw some relief from the rate cuts, underlying inflation still remains sticky. I think it was around the 3.2 to 3.4 thereabouts, which led the RBA to sort of signal a higher for longer stance from major banks, now split on whether a rate hike will occur in February 26. So let's wait for that. For many homeowners, especially what I was with my clients, this is a sort of financial cliff moment. They're sort of anticipating waiting, and they're sort of those who had bought recently or refinanced during 25 dip are now sort of facing the reality that the mortgage relief is likely months or even years away. So that being said, it sounds fairly doom and gloom when I state it, but it's one of those things that when we did do the refinance or anticipated it, and all of you as my clients sort of understand that we always pressure tested at a worst case scenario, so we're pretty okay with that. We always are preventative with that. The second issue was the chronic supply shortage, which I say is what really drove it up, along with the housing guarantee, which I'll talk a little bit later on in the episode. But the core driver of price resilience is a massive shortfall in housing. I mean, the federal government's National Housing Accord, targeting, I think it was around 1.2 million homes by 29, is currently sort of tracking roughly about 50,000 homes behind the schedule for the year. And obviously construction costs sort of, they went up, record high building costs, which I think for the standard detached home was around the 500k mark or thereabouts, have really made it hard especially for people wanting to build. Because there are so few homes being finished, buyers are forced to complete for a limited pool of existing established homes, keeping the prices high even as though borrowing power shrinks. So we're sort of heading back to where it sort of was prior to when the interest rates started dropping. But that being said, the inflation has caused, again, the building costs to look like they're going to be going up. So if you are looking at construction, it still looks like the building costs and anything associated with the building costs still going to remain quite buoyant, or if not higher, which sort of faces you to be looking at the established market where stocks are minimal, right? And that drives a lot of the prices up. The help that hurts is what I called it, which was the government incentive. So there's a debate over the expanded 5% deposit scheme, and there's also the 2% deposit scheme. While intended to help the first home buyers, the economists were sort of arguing it's sort of backfiring. There was speculation. By lowering the entry barrier, it was flooded the market with thousands of new buyers, and I'm still seeing that today, as in new clients jumping on board with the 5% deposit scheme. So in a low supply environment, this surge in demand is simply pushing up the price of entry-level homes, sort of essentially gobbling up the financial benefit of the government provided. So we sort of did see that coming. We did do an episode in relation to that, and it was foreseeable. But, you know, it is what it is, and there's not much we can do about it. The intergenerational wealth divide, which was a major social and financial concern today, is that the home ownership is increasingly becoming a transfer of wealth rather than an earned milestone. So years ago it was sort of, you know, you save and you pay it off, whereas now the bank of mum and dad is sort of a growing percentage of first home buyers now require parental assistance sent to the market. There's nothing wrong with that. I do this quite a bit, where I help a lot of the clients sort of assist mum and dad to get them over the line. There's so many different solutions that we can provide to do that. So a lot of the time people are sort of confused. Well, how does that work? Do they give you the gift, or is it a non-refundable gift? And can they go as guarantors? There's a multiple way of doing that, but this really has sort of pushed and made property ownership even more difficult, simply because the first home owners or the bank of mum and dad is sort of helping them out, right? The rental generation, those without family equity are being pushed into a permanent rental cycle where rents are still 20% higher than the pre-pandemic levels. So 20% is massive, guys. Those of you that sort of think, well, it doesn't sound that much. Well, have you, since the pre-pandemic levels, has your wage gone up 20%? And if so, it's sort of remaining buoyant. If your income has increased by 20%, you're sort of keeping up and you're having to rent. But you see where I'm going with the numbers. Rental cycles, they are still 20% higher on average across the board. So that makes it very hard. Now, let's go on to I think it was, actually, while I'm sort of on this point, the capital city, just go over, I think I've got the figures here for January 26, the estimates of the city. So the median value for the properties, and I'll start off with Sydney. I think the median value on these figures that I've got on speculative data, just on average, was 1.28 million for medium house, property value, sorry, not house, but I'm just being very broad in its approach. Sydney is slowing, extreme affordability constraints, slight declines in some sectors. So that's Sydney. Now, the other one which we always like to speak about, either Melbourne or Sydney, Melbourne is down to 827k median property value, approximation, right? So 827,000, whereas Sydney was 1.28 million. Melbourne, I've got here as comments as stagnant. High supply of units and state tax pressures are weighing on growth. So we definitely need to see something in Melbourne here. And shortly, just Brisbane is at median value, approximate median value on property 1.04 million. They're booming, strong migration, and obviously the Olympic Games preparation driving double-digit gains up in Brisbane. Perth is around the 940,000 $100,000 median property value approximation, yeah, and they're surging, leading the nation in growth, really. It shows on some of these graphs that I've got as data. So very, very, very interesting stuff here. So note for investors, the focus has shifted toward build chasing in regional hubs and high density units as the traditional capital growth strategy is becoming too expensive to service in the major cities. So regional has seen that, and I've actually seen quite a bit of that, especially in 2025. Now, looking at the solutions, addressing the complex property and finance issue 26 requires a sort of two-front war structural government reform to fix their supply and individual financial strategies to navigate the volatility. So what I've done is I've sort of placed a couple of primary solutions currently being proposed or implemented in Australia. The first one was the solutions for interest rate volatility. Now, while the pivot fear keeping homeowners on the edge, so the pivot fear of sort of, is it going to happen? Is it interest rates going to go up? What's going on? The focus has sort of shifted from waiting for cuts to active risk management. And what I mean by that is the first one I listed was mortgage stress testing. So financial professionals in the industry now recommend, or they should be recommending, I believe, if not more, is the household stress test, which I always have done in many past. All my clients understand how I operate. I always pressure tested. The stress test their budgets against a 7 to 7.5% mortgage rate, even if their current rate is lower. This sort of builds a liquidity buffer to absorb potential February or May 2026 rate hikes, right? So always make sure the mortgage stress test is, if you're on an interest rate of 5.5%, I always say go with 7.5, thereabouts. Those of you who are really conservative can go higher, but you sort of get the idea. The split loan strategy, to hedge against uncertainty, many are opting to split facilities, like fixing 50% of the debt to protect against hikes, while the other 50% is remaining or to be placed on variable to benefit if the RBA actually cuts later in the year, right? So you sort of get that. They're sort of sitting on the fence. And proactive refinancing, which I'm always on this sort of thing anyway. So since lenders are pricing in or risk staying loyal to the bank can be costly, as you all know, especially in the last maybe 6-7 years, it's a good idea to think that, switch to a honeymoon rate or product that offers a lower offset account fee or something like that. I think that's going to be, it was common in 2025, was doing a lot of them, as in the refinance, especially on the more difficult loans. I think in 2026 we'll see a lot of that happening too, which, it's all about cash flow, right, at the end of the day, and getting the best, most appropriate product in the finance. Solutions for the shortage of supply in property was something sort of, for the government to sort of meet the 1.2 million home target, the industry is moving away from traditional bricks and mortar towards faster high-tech alternatives, which I've done a few of these late last year, where the modern methods of construction, the government sort of backed the pilots in South Australia and Victoria, sort of scaling up a prefab and modular housing sort of way of going about things. So by building components in factories, houses can be assembled on site in weeks rather than months, sort of bypassing the tradie shortage as what we have. I did place a little note here where it had the new homes bonus. So that was actually I wrote some information, a $3 billion $3 billion federal incentive that rewards states and territories that exceed their housing targets. This was designed to force local councils to slash the red and green tape that currently stalls the developments for years. So new homes bonus was discussed. The other one was build to rent concessions. So in 2026 has seen a surge in build to rent projects where institutions like super funds, that sort of stuff, build entire apartment blocks specifically for long-term tenants. So new tax breaks, including a 50% land tax reduction, I think it was, are making these more financially viable for developers. Reforming government incentives. I did place another list here. I should put them in the notes. To stop help from simply pushing prices higher, the focus is shifting from giving buyers money to sharing the burden, and there was I'll put the notes on how that sort of works in the description of the episode. Basically just goes through the price inflation, shared equity schemes, all that sort of stuff. Bridging an intergenerational divide to help those with out of the bank of mum and dad policies are sort of targeting wealth mobility and housing variety. So downsizing incentives. Australians over 55 contribute up to 300,000 from a home sale into their super. This was designed to free up large family homes for younger families. The missing middle density, so planning reforms are being fast-tracked to allow dual occupancies, as in duplex, and three-storey townhouses on land previously restricted to a single house. So it creates sort of cheaper entry-level homes to desirable suburbs, right? So you're not having to go all the way at the sticks if you don't want to, and get a better home or better sort of or more preferable desirable suburb. A social housing accelerator was $2 billion federal injection is being used to refurbish old public housing units, making them tenantable again and reducing the 10-year wait list that the current plagues the system at the moment, which is definitely going to help in the long term, obviously. Key takeaway of all these solutions that I did put down, I said I was only going to briefly look over it. Those that want to talk about having a look at 26 moving forward, just buzz me as normal. The key takeaways was for the individual, the solution is liquidity and flexibility. For the nation, the solution is sort of industrialising the build process with modern technology through the prefab technology and removing tax barriers to moving and all that type of stuff. So I hope you do sort of, this all makes sense. Look, I hope 26 is going to be a good year for everyone. Obviously, we've got to do our due diligence as investors, potential property owners and all that sort of stuff, even business owners. We need to do our due diligence and make sure what we're doing is sort of not over romancing with figures and making sure that we are anticipating if there is a rate hike, we are ready for it. If not, what can we do? Obviously do our homework. Happy to discuss that as well. But all the best for 2026, guys, and see you on the next episode. Thank you.